Welcome to our webinar on proactive monitoring feedback for 2015. Today we're going to be looking at the feedback that has come back from the Johannesburg Stock Exchange and the European Securities and Markets Authority with respect to their monitoring of financial statements that were prepared by listed companies in those various jurisdictions. The European Securities and Markets Authority basically covers 30 different jurisdictions across Europe, and the Johannesburg Stock Exchange looks at companies that have got a primary listing on the Johannesburg Stock Exchange. Now, as you may know, various countries around the world have started a process of proactively monitoring financial statements of companies in order to improve on the quality of the reporting that companies in their jurisdictions or that fall under their purview undertake. Now, specifically for the Johannesburg Stock Exchange, this basically brings us to the end of a 5-year cycle where they've reviewed 329 sets of financial statements. Some of them have been repeated over that particular period, and coming out of that process, they've requested that certain companies, 25 companies in total, have been asked to go back and restate their financial statements. 23 have been requested to make corrections at their next reporting date, and 56 have effectively had non-material errors which had been noted out of the review process, which were then corrected at the next reporting date. Turning to the European Securities and Markets Authority, with covering 30 jurisdictions, as I mentioned earlier on, they've reviewed 1,228 sets of annual financial statements. These reviews also resulted in some reissuances and public corrective notes having to be issued, and in some cases, corrections to be done at the next reporting date. Now, if you look at the main areas of focus for the European Securities and Markets Authority, they basically looked at consolidated financial statements and the related disclosures, again, this being a new area. They've looked at financial reporting by parties to a joint arrangement. You may be aware that this has been the subject of discussion at the Interpretations Committee at the ISB, with the issuance of a note in 2015, and at the same time they've also had a look at the recognition and measurement of deferred tax assets, the information that is taken into consideration in recognizing and measuring deferred tax assets, and the disclosure that is provided around uncertain tax positions. Again, with uncertain tax positions, this will be the subject of some guidance coming out of the ISB that we're hoping will be issued in the near future. Now, there's some stats as to what has come out of the review process. There have been some forced corrections, as you'll see from the bottom line that I've got in this table, across both the South African market and the European and Europe. But ultimately, it all boils down to what we've just been talking about now. There's been material infringements, requested reissuance of financial statements, or immediate public announcements in some cases, or in some cases corrections at future dates. Now, when one looks at the reports that have been issued by these two bodies with respect to the results of the reporting that they've looked at, there's effectively 11 areas that have been highlighted. Sloppy drafting has come up time and time again over the last 5, 6, 7 years that this process has been undertaken between the two bodies. The JSE has only been going for 5 years, but every single year sloppy drafting has come up as a finding, as it has with the European Securities Markets Authority. Now, while we understand, and I guess while there's an appreciation that in a lot of cases, when companies come to the point where they're reporting, there is a lot of pressure, there's a lot of the deadlines are looming, there's a lot of pressure on the staff that are preparing the financial statements, that are drafting the annual report to be presented to the audit committees and things. Both regulators are also saying that there's a need to take a step back and just make sure that all the T's and all the T's are crossed and all the I's are dotted as part of that process. What they're finding is a lot of mistakes that should not have made it into the financial statements, whether it be a casting error, a cross-casting error, whether it be a wording error, and in some cases, whole notes are left out on the basis that they were left out in error. And coming out of the process that they've followed, where they've gone and they've asked for additional information, additional comments from the companies that are concerned, the answer they've received back from these companies is that a particular piece of information was included in error or was excluded in error, which again, because this information has gone out into the public domain, may have misled a particular user of that particular set of financial statements where that piece of information is material. So again, it's about making sure that enough due care is taken in the whole process of crafting these financial statements to ensure that mistakes of this nature don't make it into the financial statements. Other areas that have also come up are presentation of financial statements, specifically looking at issues that relate to accounting policies and the lack of disclosure when it comes to significant judgments, and also around estimates that may have been applied in putting the financial statements together. They've identified cash flows, income taxes, financial instruments, interim financial reporting. They've also identified impairment of assets, disclosure of interest in other entities. You'll see this will have come out of the European Securities and Markets Authority, but the JSE has also dealt with it to some extent. Fair value measurement, basically the application of IFRS 13. And the last two, related party transactions and share-based payments. Now, what we're going to do today is we'll have a look at everything from number 2 to number 9 of this list of issues that have come up in detail. 10 and 11, the related party transaction issues and the share-based payment issues, those we will deal with at a high level, because what both regulators have noted is that while people may not necessarily be adhering to the requirements of the standards to the letter, there has been a significant improvement over the years. But all the same, they're still putting it out there that we should be aware that these are still areas that they're concerned about, that they're still going to have a focus on, and therefore we need to make sure that we get the disclosures right. So, starting with the first issue, or the second issue, presentation of financial statements. Now, this issue has come up time and time again over the years, and the big issue here being when financial statements are drafted, and specifically when the accounting policies are crafted to go into the financial statements, there's a tendency to provide more information than is necessary. The objective behind putting together an accounting policy, disclosing the accounting policies in the financial statements, is to enable the users of the financial statements to understand what the financial statements are trying to communicate. What you find in a lot of cases is that the way that the accounting policies are worded may obscure what may be important matters around the accounting approach that the company takes. Now, I'll give you a simple example. If you're a manufacturing business and you're providing an accounting policy relating to financial instruments, for instance, what you'll find in a lot of cases is that the manufacturing business may deal with issues in its accounting policy that relate to financial instruments that are carried at fair value, available for sale financial instruments, held for sale financial instruments, and loans and receivables. But when you go back to it and you peel everything back to try and see what exactly it is that is relevant to this particular organization, you may find that the only type of financial instrument that is relevant in their particular space is only the loans and receivables, because all they have on their books, for instance, may be debtors, there may be creditors, there may be cash in bank, or there may be creditors on their books, and that is pretty much it. But when you go through the accounting policy, they're dealing with pretty much anything and everything in order to try and make sure that they don't miss out anything. Again, to try and get back to the objective, we are trying to inform the users of the financial statements to enable them to get an understanding of the financial statements of XYZ company, not any other company out there. There's a particular company that we're focusing on in this particular set of financial statements. So therefore, the wording of the accounting policies should relate specifically to that particular organization and how it carries out its accounting function. So the disclosure that we're providing here must also be limited to what is significant to this organization. Again, not anything and everything is going to make it into the set of accounting policies, because again, ultimately, you're trying to draw attention of the user of the financial statements to what is important in the context of this particular organization. Sometimes we've found that the accounting policies may be missing certain information that relates to what are effectively non-routine transactions but have occurred in that particular reporting period. Say, for instance, there's a business combination and it happens to be a reverse acquisition. Now, in that situation, one would expect to see an accounting policy that explains how the reverse acquisition has been accounted for, or how the business combination has been accounted for. Sometimes it's things that are not so non-routine, such as when you're dealing with share-based payments for organizations that have got schemes of this nature in place. Now, in that situation, again, you would expect to have for the company to demonstrate in detail how share-based payments work within their organization, and where it's a group of companies and there's recharges of costs between different companies on relating to share-based payments, how those recharges work, and that sort of thing. So again, trying to bring home the issue of how are the accounting guidelines that are provided for in IFRS, how do they make it back into the accounting policies that are disclosed by the organization. On the matter of significant judgments, again, when you look at what is disclosed in the set of financial statements, sometimes the amount of information that is provided isn't substantial to enable the user to understand what the company has actually done. So when you look at what the company has actually done, what assumptions have been made? is there a sensitivity around the assumptions that have been made? To the extent that what the basis of those assumptions is. Now, all of that information should make it into a set of financial statements to enable the user of the financial statements, to the extent that they disagree with what has been said, to be able to understand, to be able to critique by themselves the basis in which the numbers that have been incorporated into the financial statements have been put together. I think once all of that has been put in place, and that will hopefully enable the user of the financial statements to understand what the company is trying to communicate. Carrying on with the theme of presentation of financial statements and the accounting policies as they're provided for in the financial statements. Again, you find that companies may not necessarily provide separate disclosure of material items or material expenses that may have been incurred by that particular organization. So it's not just expenses, assets, liabilities, income, and expenses. When you look at materiality, we're saying, look, it's not just a quantitative assessment of a particular amount in the financial statements. We must also understand the circumstances that led to the recognition of an item, because those circumstances may make that item a material amount. Now, depending on which regulator you're dealing with across the world, depending on the various jurisdictions, there may be certain information that may be required from a legislative perspective that from an IFRS perspective might not be material, but because it's required to be incorporated into the financial statements, that in itself would make that particular matter qualitatively material. On the other hand, from a quantitative materiality perspective, one thing that we're finding that companies don't necessarily do in the way that they should is to compute their own materiality. Never mind what the auditor's materiality may be, or the process that the auditors might follow in determining materiality. The company itself must have gone through a process of deciding, of working out what is material in its context, and basically unpacking why a particular amount, a particular transaction may be deemed to be material in the context of that particular organization. And again, in documenting all of this, it will then enable the organization to make a better judgment call in terms of what information should be included in the financial statements and what information can be excluded, even though IFRS might have a specific requirement for that piece of information to be included. You will be aware that with the changes to IS1 coming out of the disclosure initiative, the papers that have been issued by the ISB with regards to also the practice note, the draft, the discussion paper on materiality that has been issued by the ISB, the comment period closed back in February 2016, you would be aware that there will be a change, a different approach that is taken to the whole process of determining what should be included in the set of financial statements and what can be excluded from that same set of financial statements. Where IS1 would have said, or any other standard would have said in the past, that at a minimum certain information must be included in the financial statements, those words at a minimum have been taken out of the standards, and to the extent that something is not material, well, then it certainly should not make it into a set of financial statements. But again, all of this is based on the company that is preparing the financial statements, management that are preparing the financial statements on behalf of their company, having gone through a process of then deciding what information will be included or will be excluded out of the set of financial statements that is being put together. The last thing that we've got on accounting policies is the process that is followed when it comes to the correction of errors. Now, in going through this process, we need to be aware that IS 8 is very categoric in the guidance that it provides. That it refers to material prior period errors. Now, to the extent that a mistake has been made, and it's not a material number, qualitatively, from a quantitative perspective as well, then that correction should be made in the period in which the mistake is noted. Where the mistake is a material error, then yes, go back and follow the criteria that IS 8 provides for and make the change in the period in which the error was made. What we found, or what has been found as part of the process by the various regulators, is that sometimes companies identify errors and will go and make restatements to their financial statements in order to take into account the errors that have been made. And they will have, in note 45 at the back of the financial statements, a note wording that says, that reads to the effect that certain line items have been restated in order to correct mistakes that have been found. Or you might find that the wording is not as straightforward as that. It might be wording that indicates that certain line items have been changed, but it does not allude to the fact that a mistake was made at all. Now, the use of terminology that hides the fact that the restatement has been made because of an error, that in itself is problematic. And when you look at the contents of the reports that have been put forward by the regulators, as far as they're concerned, is the process that would be followed in those sort of circumstances would be tantamount to misleading the users of the financial statements. The third issue that has been addressed in the reports is the whole process of the preparation of cash flows. And when you go back to the thinking behind why cash flows are prepared to begin with, cash flows are aimed at enabling investors to evaluate the ability of an organization to generate cash and to understand the timing and any uncertainty around the cash flows that may be generated by this organization. So therefore, when you look at the categorization of cash flows, operating activities being the principal revenue producing activities of an organization, investing activities which relate to the acquisition and disposal of long-term assets and other investments that an organization may hold that are not cash and cash equivalents. And remember, when it comes to investing activities, that only expenditures that result in a recognized asset in your balance sheet can be classified as investing activities. Everything else would fall out of this particular classification definition, would then either be operating or financing activities. When you go to the definition of financing activities, the activities that result in changes in how an organization is funded. So we're looking at the size and composition of its equity, the size and composition of its borrowings. Now, obviously, the buyback of shares, the advancing of any money by financiers to the organization, the repayment of those amounts back to the lenders, all those would fall within the definition of financing activities. Nothing has changed when it comes to this definition from where we've been in the past. So IS7 pretty much remains intact. Now, what's been noted as part of the feedback process is that companies have been including in their cash flow statements items that are not cash flow items. Now, take for instance an example. Organization decides that it's going to replace its fleet of motor vehicles. It goes directly to the vehicle dealership and it asks for a quotation in order to be able to buy 10 motor vehicles. It then goes straight from the motor vehicle dealership to its bankers to ask for a loan with that quotation in hand. The bankers then pay the motor vehicle dealership directly, having approved this loan, and the motor vehicles are released to the company. Now, in the context of this organization, when it comes to preparing its financial statements, the question to ask is would this transaction that I've just described, would it result in the recognition of cash inflows, cash outflows in the company's statement of cash flows? Now, again, going back to what we've just said now about non-cash flow items, in this situation, or the example that I've just described, the cash has moved directly from the bank to the motor vehicle dealership. It has bypassed the company itself, the reporting entity. Now, the one thing that is different about cash flows, the preparation of cash flow statements, from everything else about accounting, is that the accrual concept does not apply in the preparation of a statement of cash flows. Basically, what the organization will then be required to do is then to go and work out of all the amounts that are going to be reflected in its statement of cash flows, which ones have had an impact on its cash book in that particular year. It's those particular transactions that should be included in its statement of cash flows. Anything else outside of this would then need to be shown as a non-cash flow item, and there's been an amendment to IAS 7 on the statement of cash flows dealing with specifically this sort of issue, where companies were in the past at pains to try and make sure that the cash outflow from investing activities that relate to property, plant and equipment, for instance, ties back exactly to the amount that is shown on the property, plant and equipment note as the additions figure for the year. The standard has come back. The amendment to IAS 7 clarifies that it's not the expectation that the numbers are going to tie up exactly. Hence, IAS 7 now requires that an additional note be provided in the set of financial statements that reconciles the cash flow items and the cash flow movements that occur in the cash flow statement with the non-cash flow items to enable the movement to be reconciled back to what is shown as a movement in the balance sheet. So effectively, as part of that process, it will then enable the reader of the financial statements to understand what impact the non-cash flow items have got. So just a word of warning to make sure that things like fair value movements are excluded from your cash flow statements. Any deferred consideration that is payable on a business combination, no cash has flowed as yet, so therefore that must be excluded. Share-based payment expenses. Again, if no cash has changed hands, then that particular expense line item should not be shown in the financial statements, should not be shown in the cash flow statement as a cash flow movement. And where there's imputed interest on loans, again, to the extent that no cash has changed hands, there should certainly be nothing that is reflected in the financial statements with respect to interest, and in this case, imputed interest. Now, they've also gone a step further to just talk about specific areas where they've identified shortcomings in the cash flow statement. Purchase of additional shares in an existing subsidiary that are currently shown as an investing activity. Folks, if you've made an investment in a subsidiary company in the past and you're putting in more money into that business, that's effectively a financing activity that you're undertaking. You're funding that particular organization. Payment of contingent consideration shown as an operating activity instead of financing. Again, in this situation, I think you need to understand the context in which this contingent consideration is being paid in order for you to enable you to make the appropriate classification call. Cash that is held by a subsidiary company at acquisition that is shown as a financing activity instead of being deducted from the purchase consideration. Now, in that situation, that's part of the investing activity. Your acquisition of another organization, even though it's going to become a subsidiary company, your acquisition of that subsidiary company is effectively an investment activity. So when you buy into that company and it has cash on its books, that's part of the investing activity that you've undertaken. So therefore, it must be reflected as part of that process and a deduction of the whatever cash you pay out as part of that acquisition. Now that's on cash flows. The fourth issue is around taxation. Now this is a little bit of a bugbear for me in that whenever you have any reconciliations of any sort throughout IFRS, whether it be a tax rate reconciliation or it be a reconciliation of movement in your provisions, the minute you have a line item, a reconciling item that has got insufficient, where the narration is insufficient or confusing to the user, you're basically failing at the communication process that you're trying to achieve in preparing this set of financial statements. Now, the one thing that we find is quite common in the preparation of tax rate reconciliations is the inclusion of the word other in the reconciling items. Now, however much goes into other, it doesn't matter. The presumption when one looks at the narration other in a reconciling item is that the preparer of that particular document or that particular reconciliation was unable to work out what that amount that has been allocated to other is. What makes it worse is when that amount that is shown as other is a significant amount. Now, when you look at tax rate reconciliations, because we're dealing with percentages and possibly decimals as well, what may look like a small number in the context of the reconciliation, in the context of the financial statements, may be a big number in the context of the reconciliation itself, and that must be taken into consideration. Now, what has also been found as part of this whole review process is that some companies would use the terms such as we got here, non-deductible expenses, without necessarily explaining what exactly it is that they mean. Are these items recurring? Are they not recurring? To what extent are they, are they impacting the tax computation that is being undertaken in a particular year? So all of that must come into play. What the regulators have also found are arithmetic errors that are made as part of the process of preparing these reconciliations. And again, like we said before, under sloppy drafting is that a lot of these things can be done away with much earlier on. So some of these issues would not be issues had a proper process of making sure that the financial statements are checked. If we'd gone through that process, then we wouldn't be addressing this particular issue. The last thing that we've got on taxation relates to material uncertain tax positions. Like I said, the ISB are currently working on a guidance document when it comes to this, an amendment to IS 12 possibly, not sure if it'll be an interpretation or an amendment to IS 12, but they're basically looking at providing some guidance on this. At the moment, you look at a set of financial statements and companies will have a statement included in there that states something to the effect that the taxation number that is included in the set of financial statements is based on the company's understanding of the tax laws and the regulations that exist, and to the extent that there was a change in any of these, or to the extent that the taxman was to look at them and interpret them differently, well, the number that is shown in the financial statements may be completely different. While that's understood, and while that may indeed be the case, what we should be trying to communicate as best as possible is where that uncertainty arises, or how that uncertainty has been mitigated by the organization. Now, by simply making that blanket statement around the uncertainty of the tax position, the financial statements aren't communicating very much to the user of the financial statements to enable them to understand whether or not there is a problem with the number that has been put forward. So that must certainly be taken into consideration as part of the process to see what wording can be included that would enable the user to have a better appreciation of what the tax position of the organization amounts to. Now, going back to some of the results that have come back from the regulators, this particular table that you've got in front of you now, this graph that you've got in front of you, has come out of the European Securities and Markets Authority report. And they've basically said, look, of the companies that they looked at, 40% had disclosure of information around their tax position, specifically around their deferred tax assets recognition, and they were quite comfortable about the process that was followed by these companies in recognizing these deferred tax assets and providing disclosures around why the deferred tax assets were included in the financial statements. 60% did not have sufficient information, and of that 60%, when half of them were pressed to provide an answer as to why they'd recognized deferred tax assets in their books, they were able to. The other half weren't. Now, all of this, again, comes back to what IAS 12 says to us about the recognition of tax assets, tax liabilities in our books, and certainly when you've got these uncertain tax positions, the process, what information you've considered as part of the process of concluding whether or not you are going to recognize a particular position within your financial statements. The fifth issue that we have is around financial instruments, and here it covers pretty much all three standards that relate to financial instruments: IAS 32, presentation, IAS 39 on recognition and measurement, and when you look at IFRS 7 with regards to the disclosures that may be provided in the set of financial statements. Now, the big issue here is around the differentiation between equity instruments and financial liabilities. Now, I'm going to take you back to the definitions of a financial liability and the definition of an equity instrument. When you look at the definition of a financial liability as we have it in IAS 32, there have been no changes to this over the years. A contractual obligation to deliver cash or another financial asset to another entity, or to exchange financial instruments with another entity under potentially unfavorable conditions. Or if you go to the second bit of the definition, a contract that may be settled in the entity's own equity instruments and is a non-derivative for which the entity may be obliged to deliver a variable number of its own equity instruments. Or you could find that it's a derivative instrument that may be settled other than by exchange of a fixed amount of cash or another financial asset for a fixed number of the entity's own equity instruments. Now, this is smack bang out of IAS 32. There's been no changes here. Now, if I look at the definition of an equity instrument, this basically says, whatever it is that I've got, if it doesn't meet the definition of a liability, then chances are it's an equity instrument. Any contract that evidences a residual interest in the assets of an organization after deducting all of its liabilities. Now, taking this into consideration, the issue that comes up is around when you look at the various types of financial instruments that we may have in our books. How then do we classify them? Do we make that differentiation between a financial liability and an equity instrument, given that this is pretty much the extent of the guidance that we've got when it comes to the whole process of defining it, that a lot of us would know off by heart. Yes, there's a lot more that is sitting in IAS 32 that in IAS 32 and IAS 39 that we then need to take into consideration. But given that this is what most of us would remember, the process that we would need to follow as part of that process of deciding which way we're going to go. So let's have a look at a few examples first, and then I'll go back to these definitions. If I find myself in a situation where I have redeemable preference shares, where the holders, so I'm the organization that has issued redeemable preference shares, where the holders are granted the right of redemption, either in cash or in shares. Now, in that situation, we are going to account for that as a liability, purely because as an organization, I don't have the right to deny the holder of these preference shares redemption of their shares. And in redeeming them, I'll be required to pay cash or pay them in some other financial instrument And in this case, it may be my own shares, but I don't know how many shares it may be that I will need to issue at a point in time in the future. So in that situation, that basically means that I'll need to classify that particular instrument as a financial liability. Sometimes we find ourselves in a situation where we have a loan from non-controlling shareholders of a subsidiary company, and when you look at the terms and conditions around those loans, is that the company that has been granted this loan has no unconditional right to avoid payment of that loan in cash. Now again, in that situation, when you go back to the definition of a financial liability, there's a contractual obligation here to pay in cash. So therefore, this particular instrument must also be classified as a liability. Now, if I find myself in a situation where an amount of money has been advanced to me as the reporting entity, and I can turn around to the person who's advanced this money to me, if they ask me to repay them, and I could say to them that I will not pay them back. Not that I cannot, but I will not pay them back. So I choose not to pay them back. Then that would then indicate that what I've got there is an equity instrument. So despite what the name may be of this particular financial instrument, again, looking at the terms and conditions around the instrument, that would indicate that that particular instrument would be an equity instrument rather than a liability instrument. So again, if you go back to the definition of an equity instrument, is that if I don't meet the definition of a liability, then chances are what I've got on my hands is an equity instrument. There's a few other issues that have also come out of the review process where, again, in applying IAS 32 and IAS 39 principles to transactions that have taken place, companies have not been able to get the accounting right. So, for instance, the cost of listing new shares on an exchange. You find that companies have been showing this as a deduction against equity. Folks, this is in effect an expense that should be recognized in profit or loss by the organization for the mere fact that the shares have been issued already. The next step of seeking a listing of those shares on a stock exchange, that has nothing to do with the whole process of issuing the shares to begin with. Now, if you go back to what we have in IAS 32, IAS 32 is very categoric that any costs that are incurred in regard to the issuance of shares, those costs are capitalized. And in capitalizing them, effectively what you're doing is you're deducting the amount that has been spent from equity. So, when you look at the second point that I've got on the slide there, the cost of preparation of a prospectus relating to the issuance of shares, that will be deducted from equity because that was a cost incurred necessarily in the process of issuing those of raising equity by the organization. Another area that is of concern is the measurement of interest-free loans. Again, when you go back to the recognition and measurement criteria that we have in IAS 39 for the recognition of financial liabilities, recognition of financial liabilities is always at fair value. Now, if you find yourself in a situation where you're granting a free loan, or you've been granted an interest-free loan, now from where you're sitting, if you get $1,000 on day one, which is payable in 5 years' time, at this exactly the same value, you effectively have a day one gain, because time value of money dictates that the $1,000 that you receive today will be worth, or the $1,000 that you'll pay back in 5 years' time is not worth the same as the $1,000 that you receive today. So based on that, that would then require that fair value adjustment be calculated and recognized in P&L straight away. Moving on to the next point. Point 6 on interim financial reporting. Again, some of the regulators across the world who have been looking at proactive monitoring have recently started looking at interim financial reporting. Previously, their focus had been on full sets of financial statements, so basically the annual financial statements that are prepared by organizations, without necessarily having regard for any quarterly or half-yearly reporting that may be undertaken by the organization. Now, what was noted coming out of the review process were inconsistencies between the disclosures that were provided in the half-year numbers, for instance, and the measurement that was applied to those particular numbers with what was applied in the full set of financial statements at year end. Now, folks, when you look at the requirements of IAS 34, IAS 34 has no recognition and measurement, does not provide any recognition and measurement guidance. It simply refers us back into, if it's property, plant and equipment, for instance, back into IAS 16. If it's an intangible asset, back into IAS 38, and so forth. But what it does categorically provide for is that the disclosures around those items, whether it be an item of property, plant and equipment, or an item of investment property or an intangible asset, the disclosures, if you're preparing an interim set of financial statements, in terms of IAS 34, would be done in terms of IAS 34. So therefore, the application of the requirements of the disclosure requirements that are sitting in paragraphs 15 and 16a of the standard become quite important. And effectively what you're looking at in those paragraphs is an explanation of the events, the transactions that have been undertaken by the organization that may be significant to enable a user of those financial statements to understand what has happened within the organization since the last reporting date. That's effectively what you're trying to work back to. So, when you go through it, you will see that paragraph 16a, for instance, requires a statement that explains that the interim financial report that has been prepared in terms of IAS 34 has been prepared on a basis where the accounting policies that are applied are consistent with those applied at the last reporting date. If that is true, if there have been any changes, an explanation of what changes have been made to the accounting policies that are applied. And this not only applies to the accounting policies, it also talks to the methods of computation of the various numbers that are sitting in that particular set of financial statements. So if it's provisions, if it's the whole process of recognizing accruals and so forth, all of that must be consistent with what would have been done at the year end. Also requires us to explain any seasonality or cycles that the business is exposed to. Again, you'll find that in certain, depending on the jurisdictions, some jurisdictions will have roaring trade leading up to, say, the Christmas trade, for instance, or you might have a roaring trade leading up to the beginning of a particular holy season in whatever religion. Now, in all of this, looking at all of this scenarios, we're basically saying, if that has an impact on how your business operates, then the financial statements must explain that. To the extent that there's anything that has been incorporated into the financial statements that affects people's understanding of the financial statements and it differs significantly from what was reported in the previous years, again, that must be explained. Has there been a change in the estimation process that has been followed? Has there been a change in the estimates themselves? To the extent that there has been, again, to explain that. Where you've raised new share capital, you've paid back loans, you've taken on new debt. Again, an explanation of the process that has been followed. Where dividends have been paid, an explanation, disclosure of what dividends have been paid and how they've been paid. So again, sometimes it might be dividends in specie, where you issue your own shares rather than payment of cash. Again, that must be explained as part of the entire process, explaining the movement in the share capital and the equity position that you find yourself in as an organization. That's not the end of it. The standard also requires us to explain segment information. Now, to the extent that you are required by It might be the listings rules of whatever exchange you're listed on, or it might be the jurisdiction that you're in if you're required to apply the requirements of IFRS 8 on operating segments. Again, we need to explain what revenues you've generated from external customers, what is intersegmental revenue, any profits and losses that have been generated by each of the various segments, the assets, liabilities that are sitting in your financial statements. If this has changed materially from the last set of financial statements that you reported, if there hasn't been a material change, not a disclosure requirement. If there have been any changes in the segments that you have identified as a business, and what the segment measurement criteria are that you're applying, and a reconciliation between what you're reporting in the segments in totality with the numbers that you're reporting from an IFRS perspective, and reconciling the profits before tax and obviously any discontinued operations to the extent that you've got them. Make sure that the numbers all add up. Where you've had any material subsequent events occurring, then again we talk about that. Disclosure to explain what the material subsequent events are and how, to the extent that they're not adjusting, to the extent that they're not adjusting events, what impact they're likely to have going forward. To the extent that they are adjusting events, well, then you need to explain the fact that this has subsequently happened and this is the impact that is had on the financial statements. Where you've had business combinations undertaken, again, an explanation as to the business combinations, where there's discontinued operations or divestments or any restructurings that might have occurred within your organization. Again, an explanation as to the process that has been followed and what that process is like, is what impact that process has had on the numbers that are being reported in that particular reporting period. Where you've had a business combination and the contingent assets or liabilities arising out of the acquisition, again an explanation as to what the contingent assets are, what the contingent liabilities are, what changes have occurred from the last reporting period, and how or what has driven those particular changes. All of that must come through as part of your disclosures. IAS 34 specifically refers us back into IFRS 3 on business when it comes to business combinations that we've undertaken, and it requires us to provide the information that IFRS 3 makes specific reference to with regard to enabling the user of the financial statements to evaluate the nature and the financial effect of any business combination that has been undertaken in that particular reporting period, or any business combination that is undertaken after the end of the reporting period. This will be one of your material post-balance sheet events, but before the issuance of these particular financial statements. Now, to the extent that information is available, then that must be included as part of the financial statements. And ultimately, it's information that will enable the users to evaluate the financial impact of that particular business combination, if it has occurred in the reporting period that we're looking at, or information that is, if it relates to business combinations that occurred afterwards, whatever that impact might potentially be. There must be sufficient information to enable the user to isolate and identify what that particular impact is. The seventh issue that was identified is around impairment of assets. Now, when you look at what we have in IAS 36, IAS 36 has very specific disclosures that are required where you have an impairment issue within a company. And so if we recognize an impairment charge within a set of financial statements, then there must be disclosure that is provided in that particular set of financial statements to explain the thinking that supported that particular impairment charge. Now, in some instances, there might not necessarily be an impairment charge. It might just be the process that is followed in order to assess whether or not there's impairment, and basically assessing whether or not there are any impairment indicators. Now, the one thing that has come up time and time again is when impairment indicators exist and a company deems it necessary to go and undertake an impairment test, is that once it undertakes an impairment test, what discount rate is taken into consideration as part of that impairment test. Now, what the regulators have found is that in some instances, you will have a business that operates across different jurisdictions, across different industries, and when it comes to undertaking an impairment test, the same rate is used by one company in the group that is in the manufacturing space, for instance, and the same rate is also used by another company that's in the same group of companies that's in the financial services space. And the regulators effectively have come back and said, look, that cannot be right. When you look at what the ISB guidance says in IS 36, using the same discount rate for cash generating units that are vastly different cannot be the right answer. And certainly IS 36 supports that. And sometimes what they've also found is that companies have not undertaken an impairment test despite the fact that impairment indicators may be present in a particular set of circumstances. Now, I mentioned impairment indicators earlier on, but I didn't talk through what they are. I'll talk through what they are now. IS 36 gives us a list of things to look out for when it comes to impairment tests. It says there are internal indicators and there are external indicators. Now, the list that we're going to talk through now is not an exhaustive list, but is merely meant to serve as a guideline to enable us to go through the process, to enable us to help identify the sort of things that we should be looking at as part of the process of identifying whether or not indicators of impairment exist. Is there evidence that is available that the asset may be obsolete? Is there physical damage to it, for instance? Is there a new product that has come onto the market that will effectively usurp the position of whatever asset we have on our books at the moment? Again, all of that may be indicators of obsolescence, and certainly of an indicator of impairment of that particular asset. Have there been any significant changes that have been undertaken within the business that are expected to take place within the business in the near future that are likely to result in the asset becoming idle, or that are likely to result in a restructuring of the organization or a discontinuance of a particular division within the organization, or will result in the organization having to dispose of an asset a lot sooner than it initially thought when it bought the asset? Now, any of those may be indicators that there may be a problem. Now, I'm trying to choose my words very carefully here, that there may be a problem. An indicator of impairment does not always mean that an impairment exists. So therefore, you'll still need to go through the process of doing the test and making sure, assessing whether or not an impairment charge should be recognized in the books. For intangible assets, we might have assessed the useful life of an intangible asset as indefinite, and because of changes in the market, because of maybe new competition coming into play, and competitive products coming into the market as well, we might have then assessed the useful life of an asset as finite, so we can actually attach a number of years to the life of that particular asset. Now, in that situation, that's an indicator that we may have an impairment issue. So again, that must be taken into consideration as part of the process of deciding whether or not there's an impairment issue. Our internal reporting. We've had a division or a business that has been reporting phenomenal profits over the years. Now, all of a sudden, the trend is that the profitability is starting to decline. We've now moved from declining profits into proper loss territory. Now, that decline in profits in itself may be an indicator that there may be a problem. That's the start of a problem. The fact that we then move into loss-making territory, again, that is now an indicator that says, look, there's certainly a problem here. But again, go through the process, assess whether or not an impairment charge needs to be recognized immediately. And if it needs to be recognized, recognize it immediately. Now those were the internal indicators of impairment. We also have external indicators of impairment. Again, when you look at the value of an asset, has its market value declined significantly? A lot more than what you'd expect arising out of the passage of time or normal use of that particular asset. If that's happened, that may be an indicator that there may be a problem. Are you running this asset a lot harder than you should be? To the extent that you are, again, maybe your depreciation policy or your amortization policy is not commensurate with what you should be doing, so therefore there may be a need to change that. So it's not necessarily indicative of an impairment, but it may be indicative that the process of recognizing, of depreciating the asset may not be appropriate. Have there been any significant changes in the environment in which you operate? Maybe the technology has moved on, the market, the legal environment in which we're operating has changed. Now, over the years, we've seen a lot of new environmental legislation being brought into play across various jurisdictions, and this has put a lot of pressure on a significant number of the players, companies operating in whatever space it might be, to the extent that they're impacted by those particular pieces of legislation. Now, to the extent that I'm a manufacturer and I've had to go back and retrofit my factory with air cleaning equipment, for instance, now would I be in a position to recover that particular cost? So as much as I-16 allows me to go and capitalize that cost, will I be able to recover that cost from my operations? And again, to the extent that I will not be able to, well then that must come through as part of an impairment charge, again reflected in the financial statements. At the moment, we're in a market where interest rates are starting to creep up, I think pretty much across the entire world. Again, as interest rates start to creep up, it also says that companies that have borrowed in order to finance their operating activities, they might have gone and spent money on a particular and buying on particular acquisitions, making particular investments on the basis that interest rates were at an all-time low. And now that things are starting to change, well, will those businesses continue to be profitable? So when you look at the discounted cash flow impact of all these changes, what does it say to the value of the investment? So to the extent that the return on investment does not exceed what it's costing to hold on to that investment, then that may point to the fact that we may have an impairment issue. Does the carrying amount of the net assets of an organization, does the carrying amount exceed that entity's market capitalization? Again, to the extent that you find yourself in a situation like that, you may be the target of a takeover bid, and whoever takes you over, obviously, if they were happy that the assets that you've got, are worth the value that they're carried at, well, they'll buy you for the purpose of stripping the company and selling off the assets. Now, short of that, of proving that, then that would be an indicator that the assets that are sitting on this company's balance sheet may potentially be impaired as well. So again, go and do the test. So that's an impairment. The eighth thing that has come out of this process is around disclosure of interests that are held in other organizations. Now, this has been an area of focus for at least the last 2 years. And from what the reporting by the regulators has said, will continue to be an area of focus going into the future. I mentioned earlier on that the ISB, the Interpretations Committee at the ISB, put out a paper, an agenda decision with regard to the application of accounting relating to joint arrangements. Now, this is one of the things that has come up here, because when you look at the issues that have come up, is that the regulators were concerned about the amount of disclosure that has been provided around any significant judgments that have been exercised on and any assumptions that have been made when it comes to applying group accounting. Specifically, when you're looking at when you've got investments that have been dealt with as associate companies. But when you look at the indicators that are present, they seem to indicate that control exists. Now, I'll give you an example of that. prior to IFRS 10, the whole concept of de facto control was not dealt with sufficiently in IAS 27. Now, with the issuance of IFRS 10, or the suite of 5, IFRS 10, 11, 12, 27, and 28, the amendments to IAS 27 and 28, de facto control has become more of an issue. Now, if I find myself as the biggest shareholder in any situation, say for instance I happen to be a 45% shareholder in an organization, and we call a meeting, and in calling that meeting, meeting of the shareholders, you find that there's apathy and maybe 10 people pitch up to this meeting. Now, when any votes need to be taken on any matter, assuming that I was going to vote aye on every single matter, every single motion to be tabled at that meeting, despite the fact that all the other shareholders might vote against me, chances are whatever I say would carry the day at that particular meeting. So effectively, what I've got there is a situation where I've got de facto control over this particular organization. So again, it's looking at those sort of factors, considering such factors in deciding whether or not you should be accounting for a particular investment that you may have as an associate or as a subsidiary company when it comes to the preparation of your financial statements. Again, it doesn't stop there. Sometimes you may find yourself in a situation where you've got less than a 20% stake in an organization, but you've got significant influence. You've got a seat on the board, you participate in the decision-making, in the policy-setting processes within the organization, the processes that decide on dividends and so forth. To the extent that you are participating in all those processes, that would be indicative of the fact that you've got more than just an interest that as a plain shareholder. So again, that must come through to the extent that that is a conclusion that you arrive at. Where you consolidate with less than half the voting rights like I described before, again, why? Again, explain that. You've got a very good reason for doing it. You can demonstrate from the voting patterns and so forth why you've got a controlling stake. So again, that must come through as part of your disclosures. Where you've got joint arrangements, again, what sort of joint arrangement is it? Remember, with joint arrangements, we've got different types of joint arrangements. Joint operations, joint ventures. Now, where we structure a joint arrangement through a vehicle, the conclusion that we'd normally have arrived at is that the joint arrangement that we have is a joint venture. But IFRS 11 is very categoric about this, and it says, where you've got a joint arrangement of that nature, despite the fact that it may be structured through a separate vehicle, you still need to go back and have a look to see what is the nature of the arrangement that supports, that underpins. What is the nature of this? What is the contractual nature of the arrangement that underpins what it is that we've agreed to with the other parties to this particular arrangement? Now, if this joint arrangement, this vehicle that we've set up, is effectively an extension of the joint of the ventures, then what you've got there, of the parties to the joint arrangement, then what you've got there is not a joint venture, but actually a joint operation. So instead of dealing with the arrangement as a joint venturer, you should then be dealing with that arrangement as a joint operator. So again, taking that sort of thing into consideration in the disclosures that are then provided or in the accounting, and then the disclosures that are provided in your financial statements. Cell captors are another issue that has come up. And again, depending what jurisdiction you're operating in and what the terms and conditions and around those cell captors may be, you may find that you may need to consolidate, or you may not be allowed to consolidate, you may not be permitted to consolidate those particular cell captors where they exist. So effectively, this would be a structured entity. So what the decision we're making here would be, is it an unconsolidated structured entity, or is it a structured entity that we should be consolidating going forward? Now, depending on whatever conclusion you get to, again, IFRS 12 requires that disclosures be provided in the financial statements that explain the position around this cell captive or this structured entity that we're dealing with. When you look at the results that have come back from the various from the regulators, specifically the European Securities and Markets Authority here, 19% of the companies that that provided disclosures had no reason, that provided disclosures around, or that had a situation where they had interest in other organizations. 19% of them had no reasons for consolidating where they consolidated. 12% talked about the existence of a shareholders agreement. 11% talked about other contractual arrangements that were in place. Others talked about the ownership and the fact that it's dispersed, board representation, and those various reasons that were given. But effectively, we still need to come back to a position where reasons are provided for the disclosures that are provided in the financial statements. Ultimately, what you're looking at when it comes to the disclosures that you're providing in the financial statements is that while we make presumptions that if I own anything between 0 and 20%, all I've got there is a plain old financial instrument, and I should be applying IAS 39. That's not always the case. I may find that even at that level of investment, I may have significant influence. Or if I've got a situation where I earn between 20 and 50% of an investment, that I actually have control in that particular organization. So again, what I've got in front of you now may not always apply clinically to every single situation. There may be some judgment that may need to be applied, and where that judgment needs to be applied, then that disclosure must be provided in terms of either IFRS 7 or IFRS 12. I guess in this case, if we are going to be consolidating or accounting for it in a way that is different to what one would expect, then IFRS 12 would certainly come into play. We've dealt with unconsolidated structured entities. But what we have not dealt with, that is sitting on the slide, is the provision of summarized financial information. Again, when you go back to what IFRS requires of us, IFRS specifically states that it applies to things that are material. Now, if I've got an immaterial investment in my books, then the disclosure requirements of IFRS 12 with regards to summarized financial information should not be applicable. I shouldn't have to worry about that. So again, as part of my reporting process, we need to make sure that we eliminate as much as possible any information that may not be material to the user understanding, obtaining an understanding of what the organization is reporting. The ninth item is around fair value measurement. Now, specifically on fair value measurement, they've honed in on level 3, assets and liabilities, and the fact that companies have not explained adequately the valuation techniques that they've applied in determining the carrying value of the assets or liabilities that they classify as level 3. They haven't disclosed the inputs that have gone into the valuation process, any sensitivities that might be pertinent to the assumptions that are made as part of that valuation process, and disclosure around any gains or losses that are taken through to profit or loss or through to other comprehensive income relating to these particular items. And again, the classification of items either as level 1, level 2 or level 3 in the financial statements. Again, just a reminder of what we're talking about. We got the 3 levels of financial instruments. Level 1 being where we look to quoted prices. We take the quoted price as is quoted in an open, active market, and we basically use that number for the valuation of a particular asset or a particular liability, because that's what that particular item would have traded at on that particular date in the market. Now, in that situation, there's no need to make any changes to that particular number. That would be a level 1 instrument. Now, that differs from a level 2 instrument, in that in a level 2 instrument we say, look, we're using inputs other than quoted prices that would otherwise have gone into a level 1 scenario. While they're based on observable situations, observable scenarios, effectively what we're doing is we're deriving the value of an asset or a liability by looking at the value of an asset or a liability that is quoted on some sort of market. So when you look at things like derivative instruments, when you look at things like maybe unit trusts, those sort of things, they would probably fall into a level 2 categorization. Level 3 is where we're basically going to do our own valuation. And in doing our own valuation, effectively, we're making certain assumptions, we're using a valuation technique, and so forth. Now, the inputs that we're using here are basically, will not necessarily be based on any observable market data at all, and because of that, there's certainly a need to go and explain ourselves, explain how we arrived at the numbers that we did, or the assumptions that we've made as part of that particular process. Now, IFRS 13 provides some guidance when it comes to the determination of which level you're going to classify an asset or a liability in. And it says the appropriate level for fair value is determined on the basis of the lowest level input that is significant to the fair value determination. So obviously the more unobservable inputs that I've got, the less likely that that item is going to be a level 2 or it's going to be level 1 or even a level 2 instrument. I'd certainly be looking at a level 3 for that particular asset or liability. Okay. Now, one more thing that has come out of this process of applying the requirements of IFRS 13 is that sometimes companies find themselves in a situation where they've taken a decision to dispose of a particular asset, or to discontinue or dispose of a particular division, or discontinue a particular division. Now, in that situation, we need to defer to the requirements of IFRS 5 on non-current assets held for sale and discontinued operations. Now, the one thing that we need to be aware of, which IFRS 5 states very categorically, is that the measurement provisions of IFRS 5 do not apply to the measurement of deferred taxes. We need to go to IAS 12 for that. Any assets that arise out of an employee benefit scheme, we need to go to IAS 19 for that. Any financial assets that are in the scope of IFRS 9, and I guess before IFRS 9 comes into play, IAS 39, go to those particular standards for any guidance on that. Any non-current assets that are accounted for in accordance with the fair value model that IAS 40 has got, if I've got investment property, then go to IAS 40. The same thing with biological assets that I carry at fair value. Go to IAS 41 for that. And any contractual rights under insurance contracts, go to IFRS 4 for guidance in terms of what we should be doing there. So what they've said as part of this process is that in deciding what the carrying value of these assets is going to be, we need to understand how we're going to recover the value of these particular assets. So for us to classify anything as a non-current asset held for sale, then we need to go to IFRS 5, and IFRS 5 has got all the various criteria that need to be met and so forth. But what's important here is to make the distinction between the items that are scoped out of the measurement requirements of IFRS 5 and the fact that the disclosure requirements that relate to these items are not in terms of IFRS 13. Even though the measurement requirements of those particular items might be outside of the scope of IFRS 13. When it comes to the disclosure requirements, we then need to look at what IFRS 5 has got. We also need to consider, to the extent that IFRS 5 then refers us back into any of the other standards, to see what IFRS 5 what each of those standards then says about the disclosure requirements that should be provided. Folks, that's pretty much it for this particular webinar. The last two things that we had for 10 and 11 that I spoke about relate to party transactions and share-based payments. As I mentioned earlier on, those ones we won't go through today because I think they've been raised in the past, the regulators seem to be a little more comfortable with what people are doing on these particular areas, but I think it's still something that we need to be aware of. It needs to be on our radar to make sure that we're providing appropriate disclosure requirements on those particular items to ensure that we don't find ourselves on the wrong side of the requirements there. All right. Thank you very much.